Look, this is not your average RRSP TFSA video. I'm going to show you and break down tax strategies that the CRA doesn't want you to know. This is literally what rich Canadians use to keep more of their money. And today, I'm pulling back the curtain on all of it. Picture two Canadians. Same city, same job, same income. $200,000. One pays $55,000 in tax. The other, closer to $30,000. No fraud, no offshore accounts, no shady tricks. Just structure. The difference isn't what they earn, it's how their money flows before the CRA touches it. And here's the thing, the most powerful strategy on this list, it doesn't need a corporation, doesn't need a trust, doesn't need a lawyer, just a spouse and a piece of paper. Stick around for that one. Today I'm breaking down 4 structures wealthy Canadians use, and I've organized them by level. Level 1, anyone with a spouse can do this tomorrow. Level 4 is for business owners pulling in 6 figures. Level 1, the prescribed rate loan. Level 2, the family trust. Level 3, the estate freeze. And level 4, the holding company. Each one builds on the last. And by the end of this video, you'll understand all 4 better than most accountants' clients do. Now, quick disclaimer, this is not financial advice. Always do your own research. Cool? Cool. But everything I'm about to show you is straight from the Income Tax Act. It's on the CRA's own website. This isn't some underground secret. All right, let's start with the one that blew my mind when I first learned about it. Level 1. And honestly, this one alone could save your family thousands every single year. All right, here's the setup. Let's say one partner in a household earns $150,000 and the other earns around $40,000. Pretty common in Canada, right? Now, the higher earner might think, hey, let me just give my partner some money to invest. That way, the returns get taxed at their lower rate. Smart idea. But the CRA already thought of that. They have something called attribution rules. If you just gift money to your spouse for investing, the CRA says, nope, that investment income gets taxed back in your hands, at your rate. So the whole plan falls apart. But here's the thing. The CRA left a door open, and it's right there in the Income Tax Act, Section 74.5. They basically said if you do this one thing, the attribution rules don't apply. Instead of giving money, you lend it at the CRA's official prescribed interest rate. Right now, that rate is 3%. Your spouse borrows the money, invests it, and pays you 3% interest every year. That's it. That's the whole strategy. Because it's a real loan with real interest, the CRA says fair game. The investment returns get taxed in your spouse's hands at their lower rate, not yours. The attribution rules, they step aside. Let me show you exactly how powerful this is. Partner A earns $150,000. They're in roughly the 43% tax bracket. Partner B earns $40,000. They're around 20%. Partner A lends Partner B $100,000 at 3%. Partner B invests at $100,000 and earns $7,000 in returns. Without this strategy, that $7,000 gets taxed at Partner A's rate, 43%. That's about $3,000 in tax. But with the loan, it's taxed at Partner B's rate, 20%. That's only $1,400. Now, yes, Partner B pays $3,000 in interest to Partner A, and Partner A has to claim that as income. But even after that, the family saves over $1,600 every single year on a $100,000 loan. And that compounds year after year. Over 10 years, that's over $16,000. Over 20 years, with the investments growing too, we're talking tens of thousands of dollars your family kept instead of sending to the CRA. Now, here's where you cannot mess this up. The interest has to be paid by January 30th every year. Not February, not whenever you get around to it, January 30th. You miss that deadline even once, the entire arrangement falls apart and the CRA attributes everything back to the higher earner for that year and every year after. But here's one more beautiful thing. The rate is locked. Whatever the prescribed rate is when you set up the loan, that's your rate forever. Even if it goes up next year, you're still at 3%. So, right now, with rates at 3%, this is a really good time to set this up. So, that's level one. No corporation needed, no trust needed, no lawyer needed, just a documented loan, a 3% interest payment, and a January 30th reminder on your phone. Now, level two is where things get really interesting. All right, level two, the family trust. Now, I know the word trust sounds like something only Bay Street lawyers talk about, but I'm going to break it down so simply your parents could understand it over Tim Hortons coffee. A trust is basically a legal container. You put assets in it, could be investments, rental property, shares of a business. It has three roles. The settlor, that's who creates it, the trustee, that's who makes the decisions, and the beneficiaries, that's who receives the income. Usually your spouse, your kids, sometimes your parents. Here's the easiest way to think about it. Imagine a family pizza. The trust owns the pizza. Every year, the trustee gets to decide who gets which slice and how big each slice is. The key word here is discretionary. You choose every year based on who needs it most. And in tax terms, who needs it most means who's in the lowest tax bracket. Your kid in university making almost nothing, they get a bigger slice, and it's taxed at practically zero. Your spouse who's between jobs, they get some too, taxed at a low rate. Instead of one person eating the whole pizza and paying top bracket tax on all of it, you spread it out. Let me give you a real example. Say your family owns a rental property pulling in $36,000 a year. Pretty standard for a duplex in a lot of Canadian cities. Without a trust, all that income lands in one person's hands. If that person's in the 40% bracket, which is pretty easy to hit in Canada, they're paying about $14,400 in tax on that rental income. That's almost half, gone every year, like clockwork. Now, with a family trust, that same 36,000 flows into the trust first. The trustee splits it, 12,000 to each of 3 family members in lower brackets. At roughly 15% each, total tax drops to about 5,400. That's $9,000 saved every single year. Same property, same income, different structure. And here's what surprises most people. You don't need to be a millionaire for this. If your family has a rental property, a small side business, a cottage that's gone up in value, or even a non-registered investment account that's grown, a family trust could make sense for you. The setup costs usually run 2 to 5,000 with a lawyer. It pays for itself fast. Now, I'd be doing you a disservice if I didn't mention the 21-year rule. Every 21 years, the trust is treated like it's sold everything at fair market value. That can trigger a capital gains bill. Sounds scary, right? But honestly, your accountant plans around this. They can distribute assets to beneficiaries before the deadline. It's not a deal breaker, it's just something you need to know about going in. So that's level two, the family trust, a legal container that lets you split income across your family and save thousands every year. But here's where it gets really powerful, because the trust is the foundation for level three. And level three, that's how wealthy families lock their tax bill in time. All right, level three, the estate freeze. And honestly, this is where I started to understand how wealthy Canadian families actually think about money across generations. Here's a scenario. You own something today worth $500,000. Could be a business, rental property, whatever. In 15 years, it's worth $2 million. When you eventually sell or when you pass it on to your kids, the CRA wants capital gains tax on that full $2 million of growth. At the 50% inclusion rate, half of that is taxable income. Depending on your bracket, you could be looking at a couple $100,000 in tax on something your family built over decades. So here's what an estate freeze does. You freeze your value at today's price, 500,000. You swap your regular shares for special preferred shares locked at that amount. Then new common shares get issued to your family trust. All the future growth, that 1.5 million, happens on the new shares, inside the trust, not in your name. So your tax bill, it's locked at 500,000. That's all you'll ever owe tax on. The 1.5 million in growth, that belongs to the trust now, your kids, your family. And here's where the magic happens. Remember the lifetime capital gains exemption I mentioned? As of 2026, each person gets roughly $1.25 million of capital gains they can shelter from tax. Each person. So if the trust has 4 beneficiaries, that's over $5 million in gains your family can potentially shelter. 5 million, tax-free. I love how simple the concept is when you strip it down. You freeze, they grow, everyone saves. And quick side note, you might have heard the government was planning to increase the capital gains inclusion rate from 50% to 66.7%. That would have made all of this more expensive. But in March 2025, Prime Minister Carney canceled that increase. So the inclusion rate stays at 50%, which means strategies like this estate freeze are actually more attractive right now than they were a year ago. All right, if you just got here, I'm breaking down the exact structures wealthy Canadians use to pay less tax. We've covered prescribed rate loans, family trusts, and estate freezes. Now, this last one, level 4, is for every freelancer, consultant, and side business owner pulling in 100,000 or more. And I promise you, this one is going to change how you think about your paycheck. Level 4, the holding company. Now, don't let the name intimidate you. If you're a freelancer, a consultant, a contractor, anyone who's incorporated and earning over 100,000, this is basically a second vault for your money, and it's taxed at a fraction of your personal rate. Here's why it matters. In Ontario, your personal tax rate on income above 150,000 is close to 48%. But inside a corporation, the small business tax rate is about 12% on the first 500,000 of active business income. 12 versus 48. That gap is where wealth gets built. Let me walk you through it. Say you're a freelance developer. Your corp earns $180,000. Path A, you take it all out personally. After tax, you're left with about $125,000. Path B, you only take out $80,000, which is what you actually need to live on. You pay about $18,000 in personal tax on that. The other $100,000 stays in the corp, taxed at 12%, so about $12,000 in corporate tax. That leaves $88,000 inside your corporation, ready to invest. If you'd taken that same $100,000 out personally, you'd have paid roughly $43,000 in tax, leaving you only $57,000 to invest. That's a $31,000 head start in 1 year. Now compound that over 10 years, 20 years. That $31,000 gap doesn't stay the same. It grows. The corporate money is invested with a bigger starting base every single year. Over 2 decades, we're talking hundreds of thousands of dollars in difference from the exact same income. Now, here's the watch out, and this is important. If your corporation earns more than $50,000 in passive investment income in a year, the CRA starts clawing back your small business deduction. By the time you hit $150,000 in passive income, you lose the deduction entirely. So you need an accountant who understands how to manage this. The holding company is the structure, but the strategy is in the details. So that's all 4 levels: prescribed rate loan, family trust, estate freeze, holding company. 4 structures, all legal, all in the Income Tax Act, all used by wealthy Canadians every single day. Now, let me tell you why this actually matters, beyond just the money. So here's the thing nobody tells you. The tax code isn't designed to punish you. I know it feels that way sometimes, especially around April when you're staring at your tax bill over a double-double. But the truth is, the tax code is a hallway full of doors. Most people walk straight through, head down, never trying the handles. They pay what they're told, file their return, and move on. The wealthy, they try every handle. They hire people who know which doors open. That's the only difference. But now you know. You know about prescribed rate loans, how a 3% loan between spouses can save your family thousands every year. You know about family trusts and how splitting income across your family is completely legal. You know about estate freezes, locking your tax bill today so your kids don't pay more tomorrow. And you know about holding companies, keeping more money invested at 12% instead of 48. The real loophole isn't a trick. It's not some shady offshore thing. It's knowledge. And now you have it. So here's your move. Talk to an accountant, not a buddy, not Reddit, a CPA who understands these structures. Book a meeting, bring this video, ask them which of these four strategies makes sense for your situation. Even just a prescribed rate loan, that alone could save your family thousands every year for decades. And I want to hear from you. Drop your province in the comments. I'll tell you how your specific provincial tax rate changes these numbers. Alberta, you're going to love this. Ontario, you might want to sit down. Quebec, honestly, you need this video more than anyone. If you want more videos that break down what wealthy Canadians already know, hit subscribe. I'm Jay, and this is the Maple Finance. I'll see you in the next one.